Today, I'm going to walk you through the best statistical way to invest, not only to beat the current recession, but to set yourself up for consistent returns throughout your investing lifetime. This is not my opinion, but is the statistical evidence that shows the best way to make consistent profits and invest for the highest possible return. So if you want to earn the highest return without gluing yourself to your account and sending your emotions through a roller coaster, then stick around. Let's jump right into it. What is going on, everyone? Welcome back to my channel. If at any point in today's video you have any questions or thoughts, feel free to leave them down in the comment section below, and seriously, I will get back to you. And of course, subscribe if you want to see more videos like this in the future. So obviously, there are thousands of opinions all over the internet on what is the best method to earn the highest possible return in the stock market. Some people say you should buy and hold, while others say that you should actively manage your stocks and have to do this in order to beat the market. But these are just opinions, and like I've said before, no one truly knows where the stock market will be in the short term, and even those who get lucky and guess are rarely able to reproduce this result consistently. So instead of just giving you another opinion, I want to show you the best statistical way to invest, and in order to do that, we're going to look at some research done by Charles Schwab. They studied investors between the years 1993 and 2012, and each investor was given $2,000 at the beginning of each year, and they were placed into one of 5 investor categories. The first type of investor, that they call Perfect Peter, timed the market perfectly every single year to the day and bought at the lowest possible day over that 20-year period. The second category of investor is known as Ashley Action, who simply bought at the beginning of each year when she was given her $2,000. Next, we have Matthew Monthly. Whoever wrote this must have really good dad jokes. Matthew Monthly took the dollar cost averaging approach and made equal purchases with his $2,000 spread over a 12-month period each year. The fourth investor is Rosie Rotten, who attempted to time the market but failed horribly and purchased on the highest possible day each and every year. And lastly, we have Larry Linger, who waited on the sidelines with his cash hoping to buy in at a market crash, but instead never invested his money as a result. Putting the painful dad jokes aside, this study obviously found that the first type of investor who timed the market perfectly each and every year saw the highest return at the end of the 20-year period with $87,004. While buying at the lowest possible point each year would be ideal for any investor, this is practically impossible to do consistently and would require enormous amounts of luck and attention to the news that affects the market. However, you may be surprised to know that the second highest return after the 20-year period was the individual who simply used the $2,000 at the beginning of every single year and ended the study with $81,650, which is not that far off from the investor who perfectly timed the market every year. Finishing in third place was Matthew Monthly, who had a similar strategy to the second type of investor, but instead of buying at the beginning of each year, he spread out his purchases over a 12-month period. This led to a very close third place finish with $79,510 after a 20-year period. This leaves us with Rosie Rotten, who had absolutely horrible timing, and Larry Linger, who waited 20 years hoping for the perfect buying opportunity. The investor with the worst possible timing still ended the 20-year period with $72,487. While this is obviously lower than the first 3 investors, it is still significantly higher than the investor who waited on the sidelines hoping for the perfect buying opportunity, as they ended the 20-year study with just $51,291, which is significantly lower than all other types of investors. There are 2 big lessons that we can take away from this. The first and most obvious is that regardless of which strategy you fall into, the worst thing you could possibly do is doing nothing at all. Trying to time the market perfectly is not only impossible to do consistently, but also leads investors to push off their investing goals in hopes of getting in at a better price. It's easy to say that you're just gonna wait one more year and hope that the market crashes, but statistically, it's clear that putting your money into the market as soon as you can is the best option, even if you time the market horribly and buy at the worst possible time. The second lesson is that a hands-off approach to investing really is the most effective method, and really is first, since the investment strategy that had the highest return in this study is a statistical anomaly and is really impossible to reproduce in the real world. Let me remind you that after 20 years, the investor who simply bought on the first day of every year and forgot about their investment finished just 6.8% behind the individual who perfectly timed the market each and every year to the day. Obviously, the period of time between 1993 and 2012 that was studied here did include some serious market crashes like the dot-com bubble burst as well as the Great Recession. But if you still aren't convinced, the same study repeated this test for 68 different time periods going all the way back to the mid-1920s and found that the result was exactly the same for 58 out of 68 time periods. Even the ones that were slightly different still had similar results, and those who invested on a regular basis were always beating out the individuals who waited to invest on the sidelines. That's right, not once did the individual who invested regularly come out in last place over the 68 time periods that were studied here. Okay, so obviously investing in some capacity is always going to be better than keeping your money on the sidelines, but I'm sure there are still people who feel like they can either beat the market or pick better stocks than the overall indexes. And honestly, I totally get it. There are so many news sources and articles or videos online that show people making tens of thousands of dollars a day trading short call options contracts. I am by no means trying to rag on these active traders since I have tried this investment strategy myself. But unless you have a passion for technical analysis of stocks, who wants to sit behind a computer all day staring at a candlestick chart when they could be out living their lives earning passive income and beating out 99% of these active traders? It's also important to account for the fact that these short-term traders often pay much higher taxes on their profits since these are taxed at a different rate than long-term capital gains. And if that isn't enough to convince you that long-term consistent investing is the best option, then here's another eye-opening piece of data that will put the final nail in the coffin. A majority of the best trading days in the stock market often occur within 2 weeks of the sharpest declines. To put this in perspective, if you had simply invested consistently in the S&P 500 and never sold between 2003 and 2018, you would have averaged just shy of an 8% return each year. However, if you had missed just the 10 best trading days over this 15-year period, your average return would drop to a pitiful 2.96%, which doesn't even keep up with the average inflation a year in the US. And if you had missed the best 30 trading days over that 15-year period, your average annual return would fall to negative 2.47%. It's so easy for investors to panic when the market starts selling off, but as we've seen in the past month alone, the days when the stock market skyrockets is often a day that follows a sharp decline. Over the past 6 weeks, we have broken a number of records on the stock market and have seen the fastest 20% decline in the Dow Jones Industrial Index, but have also seen the best week for this index since the mid-1930s. This just goes to show that the only people who get hurt on a roller coaster are those who jump off. You do not want to miss the rebound after these sharp declines, and this is all about having the right perspective on what your investment truly is. Hopefully, when you made this investment in the first place, you knew that you wouldn't need this money for at least 20 years, and while it is a gut-wrenching feeling to see your account balance declining rapidly in value, it's important to keep in mind that you only lose this money when you sell for a loss. The market going up and down is completely normal and is really necessary in order to have the 13+ year bull markets that we've seen since the Great Recession in 2008. On these extreme red days, just do your best to put it in the back of your head and remember that the biggest rebounds often fall within 2 weeks of the sharpest declines. And if anything, you can use this as an opportunity to lower your average purchasing price per share while the market is down. To those of you who still think you can beat the market, I want to remind you of a very popular study that I've mentioned before on the channel. The basic theory was first made popular by a professor from Princeton University named Burton Malkiel, who believed that a blindfolded monkey throwing darts at the financial pages of the newspaper could select a portfolio that would do just as well as one carefully selected by experts. Eventually, this theory was put to the test by research affiliates who determined that Professor Malkiel was wrong. The portfolio selected by the dart-throwing monkeys outperformed the one picked by the so-called experts. No, I'm not saying that it is impossible to beat the stock market by handpicking your own stocks, but I'm simply presenting you the statistical evidence and would argue that you are much better off earning passive income by having automated investments made on a consistent basis rather than sitting behind a computer day in and day out looking at a ticker change by the minute. For 99% of investors, the stock market should be a tool used to build your wealth and eventually become your source of income. Individuals often run into trouble when they try to actively trade and immediately make the market their means of income. No, with a $1,000 investment, you probably aren't going to be rolling around in a Lamborghini by next week just by purchasing index funds. But making automated, consistent investments will not only lead to the best statistical return over a long period of time, but will also allow you to focus your efforts on your true passions in life, which can earn you more income, which can then be invested to earn you more compound interest and more passive income. And if you're watching this right now in your 20s or even your early 30s, with some careful planning and sacrifice on your part, you likely won't have to wait till the magic age of 65 to retire, which seems to be the norm in the United States. Retirement shouldn't even be viewed as an age, since it's really just the point where you're earning enough passive income to support your lifestyle without working. It just so happens that for most working class citizens, this happens to be in your early to mid 60s, and the age restrictions on cashing out on your Roth IRA and Social Security only exacerbate this belief. But this absolutely does not have to be the case for you, and you really can achieve retirement in your late 40s or even much earlier, depending on how much you're willing to sacrifice right now. Regardless, in order to achieve your goals, you'll need to make wise investments, and as we've proven today, the best course of action is investing consistently over a long period of time and then leaving that money alone and letting it go to work for you. After all, that's really the whole concept of passive income. If you have any questions or thoughts at all, feel free to leave them down in the comment section below, and seriously, I will get back to you. If you enjoyed the video, don't forget to subscribe, hit the like button, and of course share this with your family and friends if you think that they could use this information if they're hurting because of the recent market decline. Thank you so much for your time, I really do appreciate it. Take it easy, and I'll see you in the next one.